Good afternoon, everyone. On behalf of the entire Crédit Mutuel Investment Managers sales team, I would like to welcome you to the Global Market Outlook of Banque de Luxembourg Investments, BLE. My name is Charlotte Boon. I am in charge of the Belgian market and I will be your moderator for this conference. Feel free to ask any question you may have in the chat box at the bottom on the right, and I will resume them at the end of the conference. Our speaker today is the CIO of BL, Guy Wagner, also fund manager of our flagship fund, BL Global Flexible EUR. Before giving the floor to Guy Wagner, maybe a word about BLI and its unique investment strategy, business like investing. Or in other words, investing like an entrepreneur on the long term in quality companies that we buy at a good price. It also means investing in companies that we fully understand, because as you can imagine, an entrepreneur won't invest in something that he doesn't understand. This actually allows us to offer transparency to our clients and to be more resilient when markets go down, because we largely avoid unpleasant surprises. You will find these return and risk characteristics across the entire range of the BLI funds that you can, of course, consult on our website. Finally, allow me to perhaps end with an example to illustrate my point, with the example of our flagship multi-asset fund, BL Global Flexible EUR, who is managed by Guy Wagner. So the fund invests in 4 complementary pockets: equities, bonds, gold, and cash, which actually would have delivered a performance of 7.5% annualized over 5 years. So this is at mid-January, so January 15th, you were at 7.5% annualized over 5 years. Over 3 years annualized, we are at 6%. So very good performance while actually absorbing or amortize the declines, as for example, last year in 2020, with a maximum drawdown on March 23 of 13.004%, while the equity indices have lost more than 30 or even 40%. Enough said, I now hand over to Guy Wagner, the architect of this investment strategy and our CIO for more than 15 years.
My conference is basically split into 3 parts. So in the first part, I'll talk a little bit about the macroeconomic environment. The second part then is about the environment for financial markets more generally. And then I'll finish with a short view on how the Global Flexible Fund is structured currently. So the first part about the macroeconomic environment, obviously, first thing to note, and we all know this, last year was a very special year. We had a very, very sharp drop in economic activity in the second quarter, followed by quite a sharp rebound in the second part of the year. What was also unusual about this is basically it was a recession that the authorities have willingly engineered by trying to limit the impact of the pandemic. And normally when economic activity slows, usually the manufacturing sector is mostly impacted, but this time the services sector was obviously even more impacted because a lot of things were basically closed. So that was really a very unusual thing last year, a very unusual year economic-wise. When we look basically now back at what happened, this is the latest forecast when it comes to US real GDP. So basically what the forecast shows that we've lost more or less something like 7 quarters. So the levels that we were supposed to obtain, that was forecast for basically in the beginning of last year, we'll basically get to that level if everything goes more or less well now, something like 1.5 years later. So basically, you can say that the economic damage was quite substantial. Second point, obviously, is this strong rebound in the second part of the year, and one has to be aware that this rebound had a lot to do with what the authorities have done. So this so-called stimulus response to this pandemic, and this one has really to be aware that this response, the stimulus response, has been historic and unprecedented. McKinsey did this comparison with what happened between what happened last year and what happened after the financial crisis 12 years ago. Basically, for each country, it shows the size of the stimulus response in percentage of GDP. Blue is what happened last year, brown is what happened 12 years ago. And you see that what was put in place last year was obviously very, very much more than what we saw 12 years ago. So really an enormous stimulus when it came to respond to the economic impact of the pandemic. And this led to some sometimes a little bit strange situations. When you look at this graph, on the left-hand side, you see personal income. Basically, during the sharp slowdown in economic activity of the second quarter, US personal income increased, which is a little bit strange given that the unemployment rate also increased a lot during that during that period. So you would assume personal income to decline because people lost their jobs. But in reality, the decline of their income coming from their work was more than compensated by transfers from the government. So basically, they got a check instead of for not working, and sometimes the amount on that check was higher than what they earned before. So basically, the US personal income increased, and again, a little bit strangely, since the situation on the labor market has improved again, personal income has decreased because some of these transfers have now been either abandoned or at least they have been reduced. So a strange situation, but a situation so where basically the purchasing power, if you want, of the US households, but it was a little bit more general also for other countries, has not really suffered too much. But obviously all these measures, this stimulus came at a cost, and here. And you could draw a similar graph for most of the industrialized nations. Obviously, that money that was spent has increased the budget deficit, and in the US, for example, the budget deficit now has gone above 10% of GDP. So really enormous budget deficits for the US, but also to some degree for other countries. But one has to note that the US has done more in that sense than other countries, and you see that on this table. Basically, it simply shows the increase in government debt last year. So that's the second column, but maybe more interesting, the last column, the fifth column, it's basically the 2020 rise in government debt per capita, and you see that the US is leading the other G7 countries, and obviously also China, which, and we'll come back on that a little bit later, didn't do that much last year. So an enormous increase in debt and the public debt, and obviously that has only increased the debt problem. That has basically that's what happened last year. But now looking forward for 2021 or even for the years to come, what can we expect? So one thing I've often touched upon, and which I think is quite important, is this structural slowdown that we've seen in growth over the last years, and especially since the financial crisis. So in most countries since the financial crisis, growth rate, here you have potential GDP growth, but also realized GDP growth has been much lower than before the financial crisis. When you look at US, for example, one used to say the US growth rate in real terms is around 2.5–3%, but since the financial crisis, it's basically been around 1.5%. So, and in most other countries also, it has been slower than before. And I think that I've often insisted on some of the structural reasons for this decline in growth rates, and I've just touched upon the debt levels. Obviously, debt levels are one point, and like for some of the other factors behind this decline in structural growth, the pandemic has even reinforced that trend, because now obviously it has led to even a further increase in the debt level. There are other things like the inequalities. There are a lot of things that weigh on this growth rates and these are basically structural problems, and also obviously demographics, because we all know growth is basically the number of people working times their productivity. If the number of people that are working is decreasing, then obviously your potential GDP growth is decreasing unless you get a very strong increase in productivity. But so I would say some of these and a lot of these trends have existed before the pandemic, have been partially reinforced by the pandemic, and so one normally would assume that we are not in front of a very strong increase in economic growth. But that's more the structural part of the situation. The more cyclical part of the situation is that there are some factors which could lead to a very good year when it comes to economic growth. The first obviously is, and obviously all this is dependent on how the pandemic will evolve, whether the vaccines will be successful, etc. But obviously there's a lot of pent-up demand. When you look at household savings, here you have this graph for the US, for the Eurozone, but it's a little bit similar in most countries. Household savings rates have increased a lot last year, basically for the simple reason that people couldn't spend money. And so obviously if the vaccine campaign is successful and would lead to a complete reopening of the economies, then there is a lot of potential demand there. Pent-up demand from last year, savings are there, the disposable income is there to increase private consumption quite a bit. So that's potentially, obviously, a very positive factor. Another factor is this trend towards more fiscal spending. Contrary to what happened after the financial crisis, where very expansive monetary policies were partially compensated by quite restrictive fiscal policies, this time there seems to be a willingness to abandon this fiscal discipline and to go more in the direction of increased fiscal spending. We've heard the Biden plan yesterday. So from that point of view, obviously, that's also something which could at least temporarily, if not for longer, really increase the growth rates in the industrialized countries. But one has to admit, for when it comes to this year, there are a lot of uncertainties, because basically you could construct different scenarios. When you could have a scenario where vaccine deployment is successful, plus you get aggressive fiscal stimulus, plus you have what I said before, this pent-up demand, and you could have a very strong growth rate this year, at least in the second half of this year, and potentially going into 2022. On the other hand, obviously, you could have a double dip if, and that's, I suppose, in that respect, the main reason, if the vaccine is not successful, if the virus mutates, etc., and then if the economies stay closed, then obviously there's this potential even for a double dip, and then you have some scenarios in between these two extremes. But so that's basically the situation right now. So there's not that much visibility. You have this potentially very positive factors which could lead to much stronger growth, but you still have a pandemic which is not yet under control. So that obviously opens the economy up for a lot of uncertainties. I would say that's more for the growth side of the equation when we look at the macroeconomic environment. The other side is then the inflation side. When you look at inflation over the last years in the OECD countries, it has remained quite low. We all know that most of the central banks have a target of 2%, at least for the European Central Bank and the US Central Bank. And they failed to reach that target most of the time, and even now we're still below that target. So that's obviously an environment where inflation has been quite stable, at least somewhere between usually 0.5% and maximum 2%. But in the short run, I suppose there are not a lot of reasons to expect that now to dramatically change. But in the longer run, there are a few developments one has to be aware of as a portfolio manager. The first, obviously, is this increase in the monetary base yet again. So we had monetary base is the money supply M0, so in the strictest sense, plus currency in circulation. And after 2008, obviously you see the red lines, the year-on-year growth, US monetary base increased a lot, and then last year again, but a little bit less than before. But this basically, contrary to what a lot of people believed back then, this increase in monetary base basically never created a lot of inflation. I just showed you the pictures. The inflation rates are still quite low. But this, I would say, this is this situation, or the current situation, is different from what we had 12 years ago. First of all, what in 2008, even though the monetary base increased quite a bit, money supply in a larger sense, the M2, M3s, didn't increase that much. Why? Because a lot of that money that the Federal Reserve, for example, created stayed on the balance sheets of the bank and never entered the real economy. So basically increased the monetary base, but it didn't increase M2, M3 money supply that much. This time it's a little bit different here. When you look, for example, at OECD M3 money supply, it's a blue line, year-on-year variation, you see that obviously it explodes. So and there is a long-term correlation between, makes sense, between money supply and inflation. So contrary to 2008, where it also increased, but the increase that we saw last year, is much more dramatic than we had back then. And you see it even more when you look at M2 money supply for the US. Here you see it a little bit better. So you see 2008, there was some increase in the money supply again in 2011, but nothing compared to what we saw last year. And so I think that's what's making this situation different this time, especially if we get the increased fiscal spending. A lot of this money supply, this money which is created, could enter the real economy, and there it would lead to inflation. And there was a famous book about past hyperinflationary periods by a Swiss economic professor called Peter Bernholz, and he defined two criteria, two ratios to be very critical. So one is the fiscal deficit as a percentage of government expenditure, and the second is the net buying of US treasuries by the central bank, of government paper by the central bank, again as a percentage of government expenditure. Without going too much into the details of his book, but he identified some thresholds as being quite dangerous and sometimes historically having led not only to higher inflation, but sometimes even to hyperinflation. And the US has basically, at least last year, crossed some of these thresholds. So from that point of view, again, one has to be aware of these developments. I'm not saying that we are going into a phase of hyperinflation, etc., but one has to be aware of some of these developments, and one has to be aware that the situation now is different from the situation 12 years ago. And the simple fact that 12 years ago what the central banks didn't lead to higher inflation doesn't necessarily mean that this time this can't be the case. And that obviously would be a very first of all, still this, what's also, and I suppose that's the indicator one has to look at. It's basically, it summarizes a little bit what I said before. It's basically the money velocity, so the number of times that the money supply is turning around in the real economy. And what we saw after 2008 is basically that this money velocity completely collapsed, and it hasn't really recovered. And so from that point of view, the increase of the money supply was more than compensated by the fall in the money velocity. But again, if this money velocity, you see in the end there on the right side that it's increasing a little bit. But so if that increase should prove to be sustainable and continue, then obviously you have a much more money supply times an increase in the money velocity, and then obviously the inflationary prospects would become much more real. And again, it's a very important question, because for the last 40 years we've been in an environment where after the inflationary 70s, since the 82 inflation has first declined, and since then has been at very low levels. So we used also as portfolio managers, as investors, we are used to being this environment of low inflation. And if that environment were to fundamentally change, it would obviously lead to some obviously, it could have a major impact on financial markets, which have benefited a lot from this inflationary, low inflation environment. And so, if that were to change, then a lot of things would change. Again, it's too early to say that we're necessarily going into that direction, but there are a lot of signs, I must admit, which point into that direction. Not necessarily for the first 6 months of this year, but longer term. Just to end the macroeconomic side, one has to note that what happened in the West last year didn't necessarily happen in the East. So basically, China's response to the pandemic in terms of fiscal or monetary stimulus has been much weaker than what happened 12 years ago. So contrary to what we've seen in the West. So basically, here you see China credit growth year on year. It remains quite subdued. And when you look at money supply in China, showed before the same graph for the US, and it's basically the mirror image. A much higher for China, a much higher increase in money supply in 2008, but this last year quite a small increase in money supply, whereas for the US it was quite the opposite. And what I mean by this is that basically when we talk about the very expansive monetary policies in the West, plus maybe now more and more expansive fiscal policies, in the East it's a little bit different. And so I think for some of the currencies of the East, and sometimes even for the government bond markets of the East, that might mean that they might become the new safe havens, because again there's much more fiscal and monetary orthodoxy than in the West. So brief summary then of this macroeconomic side. As I said before, structural factors continue to weigh on growth, but cyclical factors could take the lead. So basically we could get much stronger growth, but it's not sure because the pandemic is still not under control. So uncertainties remain very high. And as I just said now, is the continuation of expansive monetary policies, plus now the gradual abandonment of fiscal discipline will increase inflationary risk in the medium to long run. Again, it's not necessarily a story for this year. It might become a story for this year, but it's more a story longer term. What does all this mean for financial markets? So the first, obviously, conclusion and the confirmation, I would say, that we got last year is basically that the central banks will remain very generous. And obviously it's a very important conclusion and consequence for financial markets and for portfolio managers. So here you have the central bank policy rates. Red is the Federal Reserve, blue are the other central banks of the developed countries, ex-US. And you see that the US tried to start to normalize its monetary policy starting at the end of 2015. This basically lasted until beginning of 2019. But then we see strong fall in the stock market in the fourth quarter of 2018. The Federal Reserve reversed its policy, and since then, and especially with the pandemic last year, it has again reduced its interest rates, and it's now basically at the same place where you see the other central banks, so with interest rates near zero. And all of these central banks, or most of the at least the most important central banks, have already said that they don't see a tightening of their monetary policy anywhere in the, I would basically say, in the years to come. The Fed under Powell has now recently said that they don't expect a monetary tightening before 2023 at the earliest, but the market even expects 2025. The European Central Bank under Lagarde basically says the same thing. So basically we are in an environment where monetary policies should remain extremely expansive. And even if there were to be an increase in inflation, in the inflation rates, again, central banks have already said that they are willing to tolerate inflation even going above their 2% target before tightening. So from that point of view, at least when it comes to short-term interest rates, an environment which remains very constructive, basically for equity markets. Central banks usually only control directly the short-term rates, not necessarily the long rates, which are normally determined by the market. And one could say, yes, but if the market participants expect inflation rates to increase, they will ask for a higher risk premium, so they will ask for higher bond yields. That's normally true, but in the current environment, I'm not necessarily sure whether the bond markets, if this logic will still function. Why? Because when you look at this graph, you see what I said before, the debt problem, blue line G7 debt to GDP. It's the left-hand scale, and the red line the cost of the debt. So basically, the G7 10-year U.S. Treasury right-hand scale. And what the graph shows you is obviously that, yes, there's a debt problem, but it's not really a problem right now because the cost of the debt is so low. And I think this situation limits to a certain degree the rebounds that we could see in bond yields, in long-term interest rates, for the simple reason that if cost of that debt becomes too high, then we have a problem. So authorities will do everything they can to limit any increase in bond yields. At least for now, that's to a certain degree a working assumption that we're using. That doesn't mean, and I've seen that, for example, in the US, the 10-year bond yield has increased a little bit. I'm not calling that a strong fundamental and structural rise in bond yield. That's just a blip. But if really bond yields were to increase a lot, I think that authorities would step in and try to get bond yields lower again. And it's a little bit what basically the Bank of Japan has done in 2016. It's what's often called the control of the yield curve. So what they try to control the whole yield curve, not only short-term interest rates, but the whole yield curve by basically anchoring the 10-year bond yield at zero. That's what they did in 2016, and you see here that since then, basically the bond yield has remained around zero. Sometimes it has even gone a little bit more negative, but mainly the bond yield has been maintained around 0%. And obviously central banks, with all the ammunition that they have, obviously can buy a lot of government bonds and make sure that bond yields remain very, very low. So for now, at least, the idea is to say, we have, even if inflation were to increase, then maybe the bond markets and the bond participants would sell because they would say, okay, but with an increase in inflation, I'm in a losing position. But then on the other hand, you have a very willing buyer who's price agnostic, who doesn't care about the return on what he's buying, and that's the central banks. So from that point of view, you could still see bond yields remaining very low. So basically, you have this situation, and again, I'm coming back now. I say to look at it from the perspective of a portfolio manager and a manager of a balanced fund. You have basically a situation where you have the situation on quality bonds. So if you stick to government bonds, then you have here's the situation in the US, and for other countries it's even worse. You have a 10-year bond yield which is very low in nominal terms and even negative when it comes in real terms, so adjusted for inflation. And again, for other countries it's even worse. So you're in a situation where you say, okay, I basically, as a balanced portfolio manager, usually I use equities, I use bonds, I use cash. But cash, we've talked about it before, there's no remuneration on cash. And again, even with low inflation rates, in real terms, you're even losing money. Same goes for quality bonds. So that's basically the situation you have right now. And one has to be aware that even with all this optimism that you can see now sometimes about the economy, it's still amusing to note that the value of negative yielding debt is still increasing. So you would assume that really if everybody was so optimistic about the economic outlook, then bond yields would at least increase a little bit and the value of this negative yielding debt would fall, but it hasn't been the case yet. But so then to come back to my to do what I just said. So if as a portfolio manager you say, okay, I have a problem with government bonds, cash is not very attractive. So by definition, then you're back you're basically back to equity. So what can one say about the equity markets this year? Basically, the first thing is, or last year, first thing is, we all know that the equity markets had a very interesting year, but basically most of the equity markets now are higher than they were 12 months ago. So they are higher than they were before the pandemic, even though the pandemic did a lot of damage. I've shown before damage to economic activity, but here you see also damage to earnings per share. Here you have the situation for the S&P 500, and basically you could say that the earnings per share that 1 year ago were estimated or forecast for third quarter of last year, we might get to that level in third quarter of this year. So again, basically we've lost a year, and still, in spite all that, the equity markets are higher than last year. So it's you could say there's some people are talking about this disconnection between fundamentals and stock prices, but one has to be aware that equity markets have gone up a lot last year, and earnings have fallen. So if you have this combination, rising stock prices and falling earnings, this basically means that equity markets have become even more expensive, that valuation multiples have increased again. And that's the case. And for example, when you look at the S&P, this is basically on the left here, 45%. This is what the S&P did over the last 2 calendar years. But you see on the right, you see that basically during that period, earnings have declined. So despite this decline in earnings per share, the market is up by 45%. This obviously means that price earnings multiples have increased enormously, and that's what you see there. So you have, over the last 2 years, you have an increase in equity prices, and I'm talking here for the market in general, which has basically which is only explained by a very strong increase in multiples, earnings having even fallen over that period. It's a little bit different it's a mirror image of what we saw in calendar year 2018. If you remember, back then, 2018 was negative for equity markets. So equity markets fell in 2018 despite very good earnings growth. So obviously back then we had a fall in multiples, a fall in price earnings ratio. Why? Because in 2018 the Fed was still engaged in tightening its monetary policies, bond yields were rising, and obviously higher rates led to a compression, to a reduction in multiples. Since 2019, it's been the opposite. The Fed has become more and more generous again. Bond yields have fallen, and we've seen this increase in multiples. But again, one has to be aware of that. One has to be aware that this good performance of equities over the last 2 years, to a very, very, very large degree, is due to rising multiples. It's not due to rising earnings. So that's something one has absolutely to be aware of. So when we look at valuations, so where are we now? Simple fact is that in most countries and for most markets, valuations are quite high. Here you have the valuations, left is US, right is the Eurozone. It's based on, it's not my favorite indicator, but here it's based on forward price earnings. So earning prices based on ratios based on earnings expected for this year. And you see that the US is very high. Europe is maybe not at the levels from 2000, but still, when you look at it, quite on the high side. Japan is a little bit different, but one has to note that the scale is different. So, but compared to its history, Japan remains quite cheap, and emerging markets are somewhere also in the middle. But so generally speaking, equity markets valuations are quite high, and even some people are even talking about a bubble. Given this also other signs of speculative excesses when it comes to these Teslas, the retail Robinhood investors or Bitcoin, you see a lot of some of the rise again in IPOs. So a lot of the typical signs of a market, a bubble market, where you see a lot of speculative excess, in reality are present. The reason why I hesitate to call this a bubble is basically that for me a bubble is a complete disconnection between the stock prices and the fundamentals. And I would say that this time this isn't the case, because basically the high valuation multiples that we're seeing nowadays as a result of the low interest rates. And this shows this a little bit. When you look at on the right hand side, October 2000, you see basically that the bond yields on an investment grade bond were quite high, above 8%. And based on this model, this would basically justify a price earnings ratio of around 12 for the equity market. However, the market was trading much higher at 23, and so basically it was very much overvalued. 10 years later, in the middle, October 2010, the bond yield had dropped to 5.8%. Theoretically, that would have justified a price earnings ratio of 17. Market was at 13, so it was quite cheap. And nowadays, even though the market multiple has increased since then, and is now even higher than 20, around 22, 23, one has also to note that the bond yield has fallen even further. It's now at 3.5%. And this model would theoretically suggest that you could even have higher multiples without necessarily speaking about the bubble. That's simply this idea. I'm not saying that low interest rates always justify higher valuations. Usually in the past, low interest rates basically reflected an economic situation which was quite bad, and so it was quite bad for company earnings. And so there was no reason for higher multiples. What's so unusual about the last years is that these very low interest rates do not necessarily reflect an economic situation which is very bad. And so company earnings have not suffered that much. And so from that point of view, in such an environment, you have the positive aspect of low interest rate, but without having the negative aspect with the impact on companies' earnings. So it's a little bit different this time. And one has to be aware of that, and obviously the companies or the sectors which benefit the most from that situation are the so-called growth sectors, because in these industries, in these sectors, you often find companies, and obviously the technology sector is a good indication, where companies can still show some structural growth, and so they obviously benefit disproportionately from these low interest rates. But so this is what happened last year, or over the last 2 years, this increase in multiples. What now for this year? Can we really expect multiples to increase even further? I would doubt that, for the simple reason that I don't see if really this increase in multiples was based on the fall in interest rates that we've seen over the last 2 years. I don't see how interest rates could again become even lower, unless really there's really a major problem in the economic situation, and then again it would not be very helpful for the equity market. So difficult to see an environment where multiples could increase even further. On the other hand, should we expect a sharp drop in multiples? Usually multiples drop when interest rates rise. Again, not necessarily something that we expect to a major degree this year. So all in all, this would mean a market where we should expect multiples to remain more or less flat. Normally, what should happen doesn't necessarily happen, but that's something that one could say. One could say for this year we expect a market where multiples should stay more or less stable, and so if we get equity returns, it must come from the earnings side, from the company earnings side. And just to show you this a little bit, this is for the S&P. Historically speaking, this is basically the average performance of the market during flat multiple years. So on average, the market then has done 7%. Obviously, on the right, if price earnings increase, then you get earnings growth plus multiple expansion, and then the equity returns are much higher. And on the left side, when multiples drop, you might get earnings growth, but that's more than compensated then by lower multiples, and then often the market declines. So, and that was basically what happened in 2018. So left was 2018. Right was 2019, 2020, maybe middle will be 2021. But again, just to as I said, talked a lot about these valuations. Obviously, a lot of when we say that valuations are high, that's basically compared to historical averages, and that's in absolute terms. But again, and that's to come back to this idea that we're not necessarily in a bubble. When you look at this graph, it shows the equity risk premium for the US market. If you only look at the bottom graph, you basically see that this risk premium is around 3.7%. That's more or less in line with its historical average. And again, it's completely different when you look 2000, and the equity risk premium was negative. So clearly sign of a bubble. This time it's not the case. And when you look at the Eurozone markets, it's even the equity risk premium is even higher. Again, the situation contrasts with what happened in early 2000, where we were in a bubble and the equity risk premium was negative. So again, that one has to be aware of that, and so that's why I think, despite some of the signs of speculative excesses, I'm hesitant to call this a bubble. I'm just saying equities are high because interest rates are low, but what that also means, I'm not underestimating this fact that equity markets are high. I'm just equity multiples are high. I'm just saying that the conclusion one should draw from that is not necessarily to get out of equities. The conclusion one should draw from that is that one has to lower and quite dramatically lower one's expectations for future returns. Because basically what has happened through these monetary policies and this lowering of interest rates is that the expected return basically on every asset class is falling. Here you have this traditional graph where you have different asset classes. The vertical line shows their potential return. The horizontal line their risk, and it's the typical idea that we've been learning, which is basically if you take on higher risk, you should be compensated for that higher risk by a higher return. Or to put it differently, to expect to be willing to expect if you're looking for a higher return, you have to accept more risk. And so basically, but in the past, basically everything started with a risk-free rate, which might have been around 3%. Then you added a premium, you got to treasuries. You added another premium, you got to high-grade bonds. You added another premium, you got to quality stocks, etc. So 3 plus, let's say, an equity risk premium of 3.5% for quality stocks. You got 3 plus 3.5, you were 6.5%. Now everything starts with basically a risk-free rate of 0. So again, even if you apply the same premiums, obviously the expected returns are much lower. And that's something I think everybody should be aware of. The price to pay for this rise in equity markets, and especially this rise in equity markets based on increasing multiples, will be lower future returns. Price determines return. That's always been the case, and again, that does not, this correlation between price and return, multiples and return, doesn't necessarily function in the short run on a one-year basis, but in the long run, it has always proven to be existing. So, and that's also why I think that this trend that we see now sometimes towards indexing passive investments is so to a certain degree stupid, because I think indexing and passive investing makes sense if markets are very low, because then you could say, okay, stock prices are so low, I'm simply buying the index. Why should I go into a lot of trouble to do some stock picking? Everything is cheap, so I'll benefit from the generally rising market, and then obviously indexing might make sense. But this time is very different. The markets, the indexes are quite high, and I think this means that as a portfolio manager, as an investor, you have to be very active. You have to make some bets, and especially you have to basically go away from this idea of benchmarking and indexes, even if sometimes it hurts. And so, what are some potential avenues for looking at active bets? Obviously, a lot of people will speak about this growth value thing. I don't necessarily like these styles, but that's markets seem to like this distinction between growth and value, and obviously we all know that growth has outperformed massively over the last years. In the US, one firm has shown, however, that, okay, we might have had now 14 years of outperformance of growth, but this is only following 66 years of outperformance of value. So one has, again, if one makes these comparisons, these historic comparisons, one always has to be aware of where do you put your starting point, etc., etc. But more to the point, I think when you look at this distinction, value growth, usually value, or in lot of cases, value investing simply means buying companies often which have problems in sectors which are in structural decline. And so, again, it's not something that we are doing. There might be from time to time rebounds in these companies or in these sectors, but structurally, one has to say that either something fundamental changes in the macroeconomic environment. For example, when you look at the banks, which typically are part of the value category, you need normally a steeper yield curve so that their interest margin is re-established, etc. So, but we don't see that right now. So from that point of view, there might be rebounds in the banks. The banks might look very cheap based on price book, etc. But again, it's not necessarily an environment where this type of companies should now start to structurally outperform, at least not the Western banks. Then you have typically in the value category, you have commodities. Again, it's typically a sector, they're price takers, so it's typically a sector where we don't invest in. And then also in this value category, you have sometimes cyclical industrials, etc. That some ideas, sometimes you find ideas in that area, that's a little bit different. But again, one has to be aware that, and this outperformance, again, of the growth style, if the growth sectors is not really a sign of speculation. It does make a lot of sense, because usually you find better companies in the growth segment. You find companies which, even in an environment where economic growth is very moderate, you find companies which can structurally increase their earnings much more. And obviously these companies have been and might remain the main beneficiaries of an environment of very low interest rates. And on the other hand, again, as I said before, in the value category, even there might be rebounds, there might even be periods of outperformance of the value style, which last a little bit longer. But unless we'll get a fundamental change in the macroeconomic environment, again, we would still, we anyway, because it's our investment methodology, but one should still basically favor the growth style. When I say a massive change in the macroeconomic environment, obviously what I talked about in the beginning about the inflation outlook, if we were to go enter an environment of much higher inflation, then things might change. But again, it's too early to think that we are there yet. So again, I don't necessarily like this distinction value growth. Sometimes within the value segment, we find companies which might be of interest to us, but one shouldn't become too dogmatic about this whole value growth thing. Another potential avenue to look at when doing active bets would be when it comes to regions. And often you hear this argument, you see this graph showing the massive outperformance of the US market since the financial crisis. Blue is the S&P 500, red are the other MSCI, markets of the industrial countries. And you see this enormous outperformance, and then often you hear this idea that given this outperformance, one should underweight the US market and favor, for example, the European market. Problem with that is that obviously sector composition, when you look at the European markets, they have underperformed because there's much more banks, there's much more of these value sectors within the indices, and the S&P has obviously outperformed because it has much more structural growth companies. But even more to the point, even this outperformance of the S&P 500, it's basically due to 6 companies. We all know these companies: Facebook, Apple, Alphabet, Amazon, Netflix, and Microsoft. And you see here, basically blue are these 6 names. Red is then basically the S&P 494, so the 500 minus these 6 names. And you see that if you take out these 6 names out of the index, the outperformance of the US market is not very dramatic anymore. So basically, in a lot of cases, the markets, US companies are not more expensive than European countries or Asian countries. It's a big difference, obviously, are these technology names. And it's also these technology names, when I in the beginning spoke about this strong increase in multiples, obviously the technology companies have benefited hugely from this increase in multiples. You see that here, for example, with Apple. So you have Apple, who recently was at $133. Beginning of 2019, it was at 35. If the Apple stock price had simply only reflected the increase in Apple's earnings, it would have gone from 35 to 47. But it has gone from 35 to 133 because not only were Apple's earnings increasing, but the market was still is willing to pay these earnings ever more higher. So the multiple has increased a lot. So again, that's one has to be aware, and that's why also we don't necessarily like this simplistic idea to say, oh, look at the US market's outperformance, so now we have to underweight that market in favor of Europe and Asia. It's a little bit too simplistic, because it's basically, it's a call on technology then. Looking to Asia or emerging markets in general, that might be an interesting idea to look at a little bit more closely. You see here that history shows that there have always been periods of out and underperformance of emerging markets compared to industrialized markets, and we've had now a period again of underperformance which has lasted quite some time, which is partly explained by the fact that also when you look at earnings per share developments, this is the red line, it's basically also earnings per share have lagged in emerging markets, so increase in earnings per share has lagged compared to developed markets. So to a certain degree, it was also logical to see emerging markets underperforming. But again, the underperformance seems a little bit too much, and we've started to see in the second half of last year emerging markets starting to outperform, and I think that longer term it's clearly a region one has to look much more. It's a little bit this idea of looking more towards the East, generally speaking. East being obviously Asia ex-Japan, but East being also Japan, and Japan is a market I've talked about a lot, and it's often difficult to get people excited about that market, because obviously there was the bubble of the end of the 80s. Since then, the market for nearly 20 years essentially declined, and a lot of people are no longer interested in that market. You see here that at least in dollar terms, in yen terms, it's not the same, but in dollar terms, the market has recovered, is back to the level it was 30 years ago. That's obviously nothing to be too proud about, but at least you see that since 2010, the market is doing quite well. And again, you could go even further. If you exclude the financials, then basically the market has done quite well over the last years. And it's a market which the weighting of the Japanese market in my fund has been quite high for quite some time. It's a market I still like a lot, because first of all, it offers a nice mixture of quality companies with strong secular growth, but also of quality cyclical companies. So it has basically a good combination of both. And the other thing, and the main problem for the Japanese market in the past, had been the low profitability of Japanese companies. So return on equity has always been lower than for the rest of the world. But since I would say financial crisis, or a little bit after, this has changed. So return on equity of Japanese companies has increased, is now near the levels of what we used to in the West. And despite that, the Japanese market is still trading at a discount. Could also say that whereas shareholder value has been taken to extremes in the US, it is only starting to happen in Japan. So again, a lot of reasons, I think, which make me quite optimistic about the Japanese market. It's certainly a market that I still like quite a bit. Another area of active bets is basically, I'm coming back a little bit to this situation for a portfolio manager of a balanced fund, this split between equities and bonds. In the past, often you saw this balanced fund 60-40, 50-50, which were basically 60% equities, 40% bonds, or 50% equities, 50% bonds. Back then, bonds offered something like maybe somewhere between 2 and 4%, equities a little bit more, and with this 50-50 or 60-40 allocation, you still had quite a nice return. I think this has changed because obviously the 50% you would have put into bonds, at least into the government bonds, nowadays don't give you any return anymore. And I think so as that you have to go a little bit outside these ideas. And it's a way I try to do it more and more within the Global Flexible Fund, is that from 50-50 I'm going more to this 50-20, 15-15 combination. What I mean by that is obviously first 50 are still equities, but then within the I would say the part that traditionally would have been allocated to bonds, I try to replace part of that through an allocation to equities, but equities in very defensive sectors, equities which offer a decent dividend yield, potential to increase their dividend, and typically these sectors are sectors like consumer staples, sometimes also healthcare. So the idea being that obviously I'm replacing part of the allocation that in the past I would have allocated to bonds by equity, so there's more volatility, but I think that makes a lot of sense in the current environment, and I think that that's something that institutional investors will need to do more and more, because a lot of these institutional investors, the pension funds, the foundations, etc., they need some recurring income, and this recurring income, these recurring revenues, obviously they don't get that anymore from the bond side, unless they take a lot of credit risk. And instead of taking a lot of credit risk, I think you can get some recurring revenues through dividends coming from the equity side by buying much higher quality companies. And this idea, which I've here tried to illustrate by comparing, for example, Nestle to the French government bond, the yield is obviously higher than the dividend yield of Nestle, around 3%, is more attractive than the coupon of the yield to maturity of the French government bond. There's growth in Nestle's dividends, which doesn't happen on the government bonds. Nestle's fundamental situation, whether it's debt or generally speaking fundamentals, I would say are better than France's, etc. So from that point of view, it's this idea a little bit, which is here illustrated, Unilever compared to Italy, or Reckitt compared to Spain. So it's a little bit this idea that you have within the equity category, you have some sectors which might fulfill this role. Yes, they're equities, but on the other hand, and so there's the volatility that usually you get from equities, even though these are typically low beta sectors. But again, it makes more sense for me, at least, than buying government bonds with negative yield to maturity. And another reason why I feel quite comfortable doing that now is that the consumer staple sector is not especially expensive. Here you see its relative performance, so it's quite underperformed recently also because bond yields have increased a little bit, and there's traditionally a relation between rising bond yields, rising bond yields and falling an underperformance of the consumer staple sector. But again, that's a sector I like quite a bit, which again obviously is part of the equity allocation, but for me it's a part of the equity allocation which replaces what would have typically been a bond allocation. Maybe a few words on currency. So here you see the trade-weighted dollar, and you see that it has been declining since the middle of last year. Everybody seems now to be quite bearish on the dollar. Quite frankly, yes, why not? Usually there are a lot of factors weighing on the currency markets, but often the market itself only looks at one specific factor. Remember years ago when everybody, first Friday of the month, was expecting the balance, the US trade balance, and that gave the trend for the US dollar for the following 4 weeks. Everything else was not really important. Nowadays, it seems to be this idea that the US and the Federal Reserve will be more aggressive than other central banks. Fiscal stimulus will be more aggressive in the US than anywhere else, and all this will be to the detriment of the dollar. And that seems to be the idea right now, and that helps to explain why the dollar is falling currently, and sentiment in the dollar is quite bearish. I must say, however, that I think that most of the currencies of the Western world are in the same boat. So basically, most of these countries have a debt problem. They have very expansive monetary policies. Their central banks have no credible exit plan to get back to more normal monetary policies. None of these countries wants too strong a currency because it will hurt their competitiveness and it will hurt economic growth. So from that point of view, I wouldn't expect the movements in the major currency crosses to be too extreme, especially since when you look at the so-called valuations of the major currencies, often these are models based on purchasing power parity, you see that yes, maybe the dollar is a little bit overvalued compared to the euro, but nothing too dramatic. Two currencies that stand out a little bit are the pound and the yen, which still seem to be undervalued. Again, that's interesting for me because I have quite a bit through my equity, Japanese equities. I have quite a bit of yen in the portfolio, and I like also the yen as a risk-off currency, which usually tends to appreciate when equity markets are suffering. So they help me to hedge part of my equity exposure. But it's nice to see that at least based on this graph, the yen is still undervalued. But more fundamentally, I said most of the currencies of the Western world are in the same boat. And what I said before about fiscal policy and monetary policy being more credible in the East, especially obviously than in China, that would mean that the renminbi should basically continue to appreciate. It has appreciated against the dollar since the middle of last year, but that has basically been in line with what happened for other currencies. But longer term, the renminbi could maybe go quite a bit higher, especially even though the Chinese authorities obviously will not tolerate too strong an appreciation too soon. But longer term, the Chinese currency might start to also play a role as a safe haven in portfolios. Another currency, but this time it's not a paper currency, but a hard currency, is gold. Obviously, you know that I like gold. I have an allocation to gold, but for a few years I said, okay, I like gold as an insurance, as a hedge against some of the risks that I'm seeing and against my equity exposure. But gold price is not in a clear trend. It used to be a little bit moving, going up and down, and so there was no clear trend. And a little bit more than 1 year ago, I said, now I have changed my mind. I think now that the gold price is in a lasting upward trend. And the reason I said so is because obviously this link between gold and real interest rates. So interest rates minus inflation. And you see here this correlation between the two. Gold price is the red line, left-hand scale, blue, the 10-year real yield is the blue line, right-hand scale, but it's inverted. So when it goes up, it means that interest rates become more and more negative in real terms. And obviously, negative real interest rates are a good thing for gold, which doesn't pay any interest rate. So that is no longer a handicap for gold. And historically, there has been this relationship, and I don't see in line with what I said in the beginning, I don't see real yields, real interest rates increasing in the foreseeable future. So from that point of view, that should remain to be a positive for gold, even though obviously we all know there's some volatility associated with the gold price. Also, one has to be aware that the gold market as an asset class, yes, it is a very small market, much smaller than when you look at bonds or equities. So if some of the portfolios, institutional portfolios, would want to increase their gold weightings, then obviously that would be this lack of supply might mean that the increase in the gold price might become quite dramatic. But the other, I said before, gold for me, it has in my portfolio construction, plays a role as a hedge, as a insurance to a certain degree, but also as a store of value. When we look at currencies, usually they have three functions. It's a means of exchange, it's a unit of account, so a prices are expressed in a currency, but there's also a store of value. And for gold, obviously, the third function is the important function. We don't use gold to buy our clothes, and also our clothes are the price of our clothes or of our what we buy is expressed in euros or dollars, but not in gold. But as a store of value, that's different. For example, when you look at the periods of the last 30 years, you had an average increase in the US in inflation of around 3.1%, and the gold price increased by around 4%. So you could say that despite a higher cost of living, despite an increase in inflation, your purchasing power was preserved. That's what I call a store of value. Over the same time, over the same period, the price of dollar expressed in gold, so not gold in dollar, but inverse, the price of dollar expressed in gold fell by 80%. Or even when you look at the euro since its inception, again, it's the price of euro in gold. It's not the price of gold in euro, so it's inverse. So the euro, in other words, has lost some 80% of its value against gold since its inception. And that's what I call a store of value. And that's, I think, in an environment where inflation might again play a bigger role, I think this idea of having a store of value in one's portfolio becomes more important than it might have been in the past. Gold, as I said before, I like gold in my portfolio, but I wanted to have something which amplifies the movement of the gold price. That's why I'm not buying paper gold, but I'm buying gold companies. Here you have this chart showing that usually blue lines, the gold stocks amplify the movements of the gold price. So when gold rises by 1%, sometimes these companies' stock prices rise by 3%. Obviously, that also goes in the other direction. But given that I think that structurally the gold price should be an upward trend, I like this leverage effect, if you want, this situation where the stock price of these companies amplify the gold price. And one has to be aware that over the last years and until recently, last August, when the gold price finally went above $2,000 an ounce, before that, the high had been reached in September of 2011, then followed a period where the gold price became weaker again. And you see that even though the gold price has recovered its losses and is now higher, or at least at the level of 2011, the gold miners index is still very much below its level of 10 years ago. And one has to be aware it's a difficult sector, the gold miners, the gold companies, because a lot of these companies have destroyed a lot of value. They have not necessarily created value for their shareholders. They've destroyed value. So one has to be very selective. I think some of them have learned from their mistakes and have improved their capital allocation. One also has to be aware that obviously when the gold price, like recently from August of last year, when it was at 2,000, it's now at 1,830, so it has fallen a little bit, and then immediately that has a negative effect on the gold miners stocks. But the gold companies, even if the gold price were to fall to 1,500 and stay at 1,500, at $1,500 an ounce, they would produce enormous free cash flows. So from that point of view, it's not a situation where they need a higher and higher and higher gold price. They need if the gold price were to remain in somewhere between 1,500 and 2,000 for their free cash flows, it would be very, very positive, and they would continue what they have done over the last months and quarters, i.e. to increase their dividends, to return money to their shareholders, etc. So again, it's not a situation where these companies necessarily need an even higher gold price to be profitable. At these levels, they're already very profitable, even if sometimes on some days when you see their reactions, you see them falling by 5 or 10%, sometimes you wouldn't assume so. But again, it's a sector I like longer term. Obviously, it comes with a certain volatility. That's the price to pay. Gold is volatile, but obviously the gold companies are even more volatile. But again, I'm willing to accept this volatility because I think that longer term it makes a lot of sense. And then just maybe one slide, again, usually I don't talk about that, but given that there's been a lot of talk about that recently, is a slide about digital gold, so Bitcoin. You see this enormous increase recently. A very good year for Bitcoin last year because it went, first of all, it fell from 7,000 to 5,000 and then it went above 30, 35,000, even it touched even the 40,000s now in January. I think again it's the same to a certain degree. The increase is a little bit the same idea. People saying that for a money for currency or to really be a store of value, its supply must be limited because if the supply can be increased all the time, like what is the case with paper currencies, then obviously it can't really be a store of value. And gold's supply is limited by potential production, and the Bitcoin supply is limited by the fact that there shouldn't never be more than 21 million Bitcoins in circulation. So that's, I think, the arguments a little bit behind the rise are the same. Obviously, otherwise it's a very different animal. I think so what has increased or what has led to this strong increase in the Bitcoin price at the end of last year was Fidelity's willingness to accept it as collateral. There are more and more custodian arrangements now being put in place, and so it becomes something that institutional investors are increasingly looking at and are increasingly willing to consider as an alternative asset class. So that's something that one has to be aware. I'm still I still don't know enough about Bitcoin to use it in my fund, but again, I think there's the times where one could simply say that it's pure speculation, doesn't need to be taken seriously, it seems to be over. So my summary of all this is that, as I said before, we have high equity valuations in absolute terms, but that doesn't necessarily mean that we should exit equity markets. It means that we should lower our expected returns. As I said before, equities remain attractive compared to bonds. One could construct a very nice scenario this year for equity markets by saying, okay, on the one hand side, if the vaccine is successful, we get economic recovery with the rebound in company earnings. On the one hand, and on the other hand, central banks will remain very generous and we have negative interest rates on the other. So that's a superb environment for equity markets. However, as I said before, risk should not be underestimated. First of all, when we speak about economic recovery, a lot of that depends on the pandemic. So we have, first of all, as a pandemic, as I said before, is still not under control. So we have to see how that plays out. And then you always have to be willing to look at some potential risks, even if they're not necessarily their working assumptions. So right now, bond yields are increasing a little bit. Maybe they'll increase even more so before central banks step in, and that might make the equity markets nervous. We might have a change of attitude by central banks. It's not something we currently expect, but the Federal Reserve under Powell has already shown between 2018 and 2019 that it is willing to change its position quite rapidly. Then obviously, like always, there are the geopolitics. But anyway, when you look back maybe 12 or 13 months ago, who would have expected the pandemic to become the major event? Nobody would have or few people would have listed the pandemic as a major risk for last year. And obviously, pandemic was basically the main risks that happened last year. So often risks appear that one wasn't aware of. One should especially be aware that right now the environment for the equity markets is maybe not perfect, but it's really quite good. And so it's often it's enough that conditions become a little bit less good, not necessarily bad, but a little bit less good for equity markets to suffer. So one has to be aware of that, especially now coming after a time where equity markets have done quite well. As I said before, I consider consumer staples as an alternative for bonds. Obviously, they're equities, but again, for the reasons I mentioned above, for me, they nearly make up an asset class of their own. This theme of go east, I think, over the next years will make more and more sense, whether it's currencies, whether it might be government bonds, or whether it's equities. I think that it's making sense. And gold, as I said before, remains a store of value. And so I like gold and I like gold companies. So just to finish all this with the asset allocation, as I said before, just when it comes to the general environment, and when you say the macroeconomic environment is basically characterized by growth and inflation, then you have four possible scenarios. You have a scenario where growth is negative or at least very weak, inflation is high. That's not good for equities. That's what scenario 1. 2 is basically still weak growth, but inflation under control, still not very good for equities, maybe a little bit better. And then 3 and 4 become then more and more positive for equities, positive growth with high inflation or positive growth with controlled inflation. We've been in scenario 4 now for more than 10 years. We would say we're still somewhere between 4 and 3, and that explains why we still have in the fund also this kind of an equity bias. So I would say, and often say to potential investors, expect equities to be somewhere between 40 and 90 or even 100%, not between 0 and 100, because there is, at least for now, still some kind of equity bias. There's obviously also this lack of alternatives. Bonds, as I said before, I tend to stick in my fund to government bonds. I don't. If I take a company risk credit, I prefer to take buy an equity of a very good company rather than a bond of a bad company. So from that point of view, I prefer my credit risk or my company risk to be on the equity side. So bonds for me are government bonds. Given the low returns offered by government bonds, I don't want to invest too high a percentage in that asset class, but I want to have this kind of leverage. I mean, I want my bond price to increase quite a bit if interest rates fall. For the bond part to be able to act as a hedge against the equity side, and that's why I typically buy very long duration US government bonds. Gold, again, I don't want the percentage invested in gold to be too high because gold and gold companies are volatile, but I want this leverage effect by buying gold companies rather than buying paper gold, and then the rest is cash. This means that now the current situation, I'm 71% invested in equities. I've decreased that a little bit. I was at 77% at the end of last year, so I took some profits and reduced the equity weightings a little bit this week. And bonds, basically, I went complete. I sold all my bonds in March of last year when the 30-year US Treasury yield fell below 1%. So bond during that period where equity markets suffered, they really played their role and protected the portfolio. But then, given that then the US Treasury yield fell to such a low level, I completely exited the bond position. Since then, the Treasury yield has increased again a little bit. That's why I've started timidly to buy back some bonds. So I have 4% in bonds, and half of that are inflation-linked bonds. Gold, as I said before, typically gold companies between 5 and 15%. But given that I now assume the gold price to be in a lasting upward trend, I don't want to go in the lower part of this range, 5 to 15. So I'm more between 10 and 15, and I'm the middle of that range right now with 12.5%, and then the rest is cash. So that's the current situation. Again, within the equity portfolio, as I said before, Japan and Asia ex-Japan, Latin America make up quite a bit. So they account for something like 23-24% of the portfolio. US is underweighted compared to an MSCI benchmark, whereas US typically is a very large part of the index. Within the sectors, it's the sectors that we typically tend to favor because of our investment methodology. So we typically tend to invest in sectors like consumer staples. I've already talked about that. Consumer cyclicals, healthcare, industrials, and technology. And so most of my companies are within these sectors, and as opposed to the typical value sectors, banks and commodities. So I finished there. I think I've taken up a little bit more than 1 hour. And if you have questions, please do not hesitate. Thank you very much for listening.
Yes, Guy. So we have several questions. First one, what about, it's on page 7 of your presentation, so maybe you can go back. What about the development of personal income during the COVID-19 crisis in regions ex-US? For example, Europe, Asia. Do you have an opinion on region ex-US?
Yeah, in most of the at least in Europe, obviously you had a different, like all of you had a different system. In the US, companies laid off their workers, and the workers received then a check from the government. In Europe, government encouraged companies not to lay off their workers and assume part of the paycheck. But in both cases, the personal income really didn't suffer that much. So you can't simply say that we had a huge drop in personal incomes, because, as I said before, in the US, the drop in income coming from work was compensated by the check from the government, and in Europe, people weren't laid off, and companies were compensated for not laying off people. So personal income didn't drop in Europe a lot, and Asia was even to a certain degree less impacted. China, by the way, is amongst the main countries, is the only one who still had a positive growth rate last year. So it's very different from what happened in the West. So basically, I would say, as a general rule, personal income didn't suffer that much last year.
Okay, thank you, Guy. Another question, how do you assess the gains from the pandemic, such as rising productivity?
Yes, that's a very good point. And as I said before, I often, when I talk about the structural declining growth rates, I give a lot of reasons, but often I simply show this one, which is basically labor force growth and productivity. And again, I would say usually the first one, labor force growth, was supposed to be linked to obviously demographics and to rising or falling populations. But what might change there, for example, is that people start to work longer, or that people who had left the workforce are going back into the workforce. So again, even with bad demographics, doesn't necessarily mean that the labor force growth has to slow that dramatically. But coming back to productivity is very difficult to measure, because it's usually taken as the difference between things rather than measured objectively. But COVID might, amongst the positive things, because a lot of the negative trends have been reinforced by the pandemic. I mean, higher debt levels, rising inequalities, etc. But amongst the few positive things, you could say maybe that we were through COVID, by having learned some things from working at home, etc. All this will lead a much quicker adoption of new technologies, etc. All this might lead to rising productivity, and I think that's a good possibility for that to happen, and that obviously would be a major positive, even for structurally for potential growth.
Thank you, Guy. Third question, can cryptos take over the role of gold, in your opinion?
Again, as I said before, I'm certainly not an expert on that. I try to learn more about cryptos recently. I've listened to a few conferences about cryptos. There's a lot of uncertainties. First of all, there's cryptocurrencies in general, and there's Bitcoin, which remains the main cryptocurrency. And I've listened more to things about Bitcoin than about the others. So, but I'm not a technology expert on blockchain, etc. All the things that are behind it. One of the major questions that nobody has yet given an answer to is that medium term, I think it's 2023 or 2024, the supply of Bitcoin should be exhausted. So we'll get to these 21 million Bitcoins, and then the supply can't increase anymore. But right now, in order to validate the transactions, you have a lot of people trying to solve algorithms, and the one who comes up with a solution validates the transactions and gets paid by getting new Bitcoins. But if the supply of Bitcoin is exhausted, you don't have any incentive anymore to do all this work. So who will validate the transactions, and who will support the whole system? And all these questions are still, I find, also during these conferences, the question often comes up, but there's no real answer to these questions. So I think it's much too early to talk about Bitcoin or cryptocurrencies replacing gold. I just see, simply by looking at the markets, that more and more institutional investors are taking Bitcoins especially, and maybe cryptocurrencies in general, more and more they're treating it as a serious asset class, obviously an alternative asset class, one where they won't put 30% of their assets, but something that they are willing to consider much more than they used to. And that obviously is very positive for the price. But you see, on the other hand, obviously, that the volatility, if gold is volatile, then obviously Bitcoin is a multiple of gold in terms of volatility.
Clear. Thank you, Guy. You were talking about so more having an equity bias. Do you have an opinion on small versus large caps in that bucket?
It depends where. No, I don't have really an opinion on, or a strong opinion on that. I think if you really believe in this idea that this year we'll get to a sooner or later very strong economic recovery, etc., then by definition you would rather look to the small or mid caps, because they offer more leverage on an economic recovery than the big caps. So, but otherwise, I don't really have a strong idea on large versus small. The fact is often that in Europe, a lot of the indices are more weighted, or when you look at the large cap indices, often they are often more, they have higher weightings in these traditional value sectors. So basically, you have the utilities, you have the telecoms, you have the banks, etc. During the large cap, within the large cap spectrum, whereas the smaller caps, especially in Europe, you have much more growth attributes, and that makes them interesting, but they're quite expensive. The US is much more equally weighted between the two, because the S&P has a lot of growth names, but then obviously the Russell also has that. So, but again, it depends a little bit on maybe on your view about the economy. If you're very bullish on the economy, you should obviously overweight small caps. Given all the uncertainties that I'm seeing, I'm not necessarily willing to make such a dramatic bet.
Okay, and still on the equity side, but on the equity hedging. So you removed mid-November your equity hedging. Do you think taking back some hedging soon, and do you think it's expensive today?
Usually when I do the hedging, that was done through the selling of futures on indices, and after the bad experience I made with that in the 2012-2013 period, I said that I wouldn't no longer structurally have hedgings in place. So what I said is that from time to time I'll use futures to hedge the equity part of my portfolio against very specific short-term risks. So I did that before the Brexit and bought back the futures afterwards. I did it before the French elections, bought back the futures afterwards. That was the only two occasions I used them, until last year, when during the pandemic I also again hedged part of the equity portfolio. And given the very rapid and strong rebound in equity prices, and given the remaining uncertainties, in hindsight I would say I've waited too long to again buy back these futures. But in the current environment, I would say I'll hesitate to use them again. Again, maybe if there was a very specific short-term risk coming up, I would do it. But otherwise, I think as a mismatch between what I have in the portfolio and what I'm basically selling short by selling futures, I don't have any banks, I don't have any telecommunications, etc. There is a potential rebound, longer rebound in value styles. So this mismatch would then penalize me very, very, very heavily, and I don't want to be exposed to that. So if I wanted to decrease my equity weighting, I would basically sell equities rather than sell futures.
Thank you, Guy. So we will end here because time is up. So thank you very much, Guy, for your time, for this very interesting discussion. If you still have some questions, do not hesitate to send us an email. The presentation was recorded, so you will soon receive the recorded version through mail. So we wish you a very pleasant day, and we hope to hear soon of you. Have a nice day.